Good evening to everyone. Welcome to the first quarter HNB results update. Uh, as usual, I'll start with the presentation and then I'll open it up for Q&A. So to start with the numbers, interest income. Interest income for the group moved up by 17% and a corresponding increase of NII of a 21% increase, and this is mainly because of the improvement that we witnessed in the margins during the quarter compared to the previous the corresponding period of last year. Fee income growth was fairly small, or it was more or less flat, where we saw fee income growing by 5% to 2.5 billion. And net interest premium also went up by 13%. Overall, the biggest impact came by way of impairment moving up to 4.6 billion from 1.5 billion as a result of rise in NPAs that we witnessed across the industry. And also other income, which shows a negative 300 million compared to 800 million plus we saw in the first quarter of 2018, was mainly as a result of the appreciation of the LKR in the first quarter of 2019. So the resultant net operating income after impairment saw a drop of 9% to 14.2 billion compared to the 15.5 billion witnessed in 2018. Other operating expenses, I beg your pardon, went up substantially. Now, let me take that separately. At a bank level, operating expenses and especially the staff expenses went up because the collective agreement or revision of salaries for non-executive staff, which happens once in every 3 years, happened in April 2018. So therefore, the first quarter, the increments were, first quarter of 2018 didn't have these increments, and hence first quarter of 2019 compared to first quarter of 2018 shows a fairly steep increase in expenses. But when you look at the second quarter, this would normalize to a great extent. So if you look at the second quarter of 2018 and compare it with the second quarter of 2019, once the numbers out, you wouldn't see this kind of an increase that you see in first quarter results. In addition to that, in April 2018, the tax laws for insurance companies changed, where the insurance companies were expected to pay tax after 1st April 2018. And as a result, in HNB Assurance, there was a revaluation of the life fund that was done, and the profits were taken into P&L in the first quarter of 2018, which normally happens in the last quarter of each year. So therefore, the line which shows as claims coming from HNB Assurance also see a fairly significant increase, which of course will normalize as the year goes on. So it's mainly because the first quarter 2018 number was artificially low because of the transfer of profits being lower in the first quarter of 2018, as you book more profits in the P&L of the insurance company in 2018 to avoid the higher taxes you had to pay with the tax changes. So VAT NBT, I will again touch on this. The effective rates have gone up. You see the VAT, NBT, and debt repayment levy going up to 1.8 billion compared to 1.5 billion, even though the profit numbers have come down as a result of the new DRL that was introduced. Income tax profit has gone down because the profits have come down, but overall the effective tax rates have gone up. I'll again touch on that. So as a result, overall PAT for the first quarter of 2019 was 2 billion, down from 4.7 billion that we witnessed in the first quarter of 2018, which is a 57% drop. And the profit attributable to shareholders amounted to 1.9 billion, which is again a 55% drop. So going through the going through the bank's numbers, which more or less reflects what I discussed in the bank numbers. So I wouldn't go in detail each of these figures. But moving on to the waterfall in terms of how profits have moved from first quarter of 2018 to first quarter of 2019, you see the major positive contribution has come through NII as a result of improvement in margins. Fee has contributed slightly. The lesser amount of taxes have contributed, but all these have got eroded through the significant amount of provisions, the increase in operating expenses, as I explained earlier, and also the drop in other income, which is as a result of the appreciation we saw in the rupee during the first quarter of 2019. So the DuPont, the main positive factor on the DuPont is the increase in NII as a percentage of average assets, which has moved up to 5.1%. So the other income has dropped as a result of exchange income being lower, and also fee growth has been only 5%. Impairment is the main increase, which was 60 bips first quarter of 2018, which has now moved up to 1.6 or 160 bips. Operating costs to average assets have also slightly moved up to 3.15 compared to 2.77 we witnessed last year. Taxation is at 1%. So overall, the ROA has dropped to 0.71% for the first quarter, and ROE for the group at around 5.9%. So at a bank level, ROA stands at 0.75 or 75 bips, and ROE at 7%. So moving on the group numbers, HMB Assurance did 119 million. Now again, as I explained earlier, insurance company profits tends to get skewed towards the last quarter because that's when the life fund gets revalued and the profits get transferred to shareholder. So in the first quarter, you saw only 190 million done by the insurance subsidiary, but I'm sure it will do better over the next couple of quarters. Microfinance had its own issues as much as the banking sector is going through the deterioration in the asset quality. The same is being felt or more by the finance companies, especially those who are in microfinance. So we saw the NPA levels moving up for HMB Finance, and the profits for the quarter was only 71 million coming from HMB Finance. Equity 2 has had its own issues in terms of the overall capital markets not doing too well, but still they managed 67 million for the first quarter of 2019. So going in detail into some of these numbers, Yeah. So the NIMs, I spoke about the NIMs, how NIMs have been improving uh, from 5.32 in the first quarter of 2019 to 5.7 by the first quarter of 2019, and at a bank level 4.87 uh, at a bank level in first quarter of 2018, moving to 5.27 by first quarter of 2019. So the NIMs have moved up as a result of interest rates remaining high, and the spread between the deposit cost and the lending rates being fairly stable. So in addition to that, if you look at the overall portfolio, you see that there is not much of a change in the mix of the portfolio. Corporate lending still accounts for about 44%, retail at around 22%, and SME, micro, and mid-market at about 34%. So that has remained more or less constant during the first quarter. So non-funded income, again, growth has not been uh, too pronounced during the first quarter as we have seen last year, but major contribution has come in from digital and digital ATM credit cards that has contributed a fairly large chunk in terms of income. And of course, trade and remittances have also been a fairly significant contribution towards the overall fee income. So in terms of cost to income ratio, over the past we have seen cost to income ratio coming down, but probably for the first time in the recent past we have seen that cost to income ratio has moved up slightly as a result of some of the points that I just mentioned, but also because the income has not been growing as fast as the increase that has taken place in the cost. Though I would expect cost to income ratios to improve over the next couple of quarters, as we would, especially at a group level, we will see the 48.2% cost to income ratio coming down and getting more closer to what you see at the bank level. So asset quality, again, is the main discussion, or what the industry has seen in first quarter of 2019 was a deterioration in the asset quality, and you see here that the deterioration of the overall bank's NPA from 2.7 to 4.6 has come mainly as a result of the increase in NPAs in the SME sector, which has seen a fairly steep increase as a result of the overall operating environment, um, and low and high interest rates, low economic growth. Of course, still implications coming through the drought that we have had. The total cash flows have not come into the agriculture sector. So all of those have contributed. Even post first quarter, the events that happened, the Easter Sunday bombings will also would not help the cause of improving asset quality. But however, it's also worth noting that central bank has taken action already, has given direction to the banking sector in order to assist the players in the tourism sector in terms of giving 1 year moratoriums in repayments, and hence we believe that will help in cushioning some of the negative impacts that could have happened if not for those initiatives that are taken. Anyhow, the direct exposure of HNB to the leisure sector is around 6%, so it's not fairly significant, but even that we wouldn't expect too much to go bad because of the moratoriums that are likely to be given in order to help the leisure sector right through this difficult period. So capitalization, we remain one of the best capitalized banks in the sector, with Tier 1 at 12.6% with a minimum requirement of 10%. However, we will require Tier 2 capital because our total capital adequacy is coming down closer to the 14% requirement under Basel III. So therefore, we have planned a debenture issue in order to help us improve on our total capital ratio. And we, I think, haven't gone to the market with a debenture issue for the last 2 years. So this infusion in terms of a debenture issue will help us improve our total capital adequacy ratio. So on profitability showed how the overall PAT and PBT has come down mainly as a result of the high impairments, but we also see how the effective tax rates have gone up from 43.6% in first quarter of 2018 to 48.6% in first quarter of 2019. And out of that, this 11.2% is actually a contribution that goes into the debt repayment levy that was introduced last year. So this was introduced saying this will stay for the next 3 years and then will be taken out. So until that point, this component also contributes a fairly large component, which goes out as tax payment to the government. So balance sheet growth overall, year-on-year balance sheet growth has been around 11% for both assets and liabilities, both advances and deposits. But if you take the quarter, it's more or less been flat in terms of December to March. So it's very unlikely that we would see the industry growing significantly this year, because even if you look at private sector credit growth in the first quarter has been flat from December to March. So these shareholder returns have not been has not been a good story, with prices of most banks coming down and HNBS being no exception. But of course, the positive side of it is you get fairly good valuations in terms of 0.5 price to book and a very low PE ratios. So with that, let me stop my presentation and then open it up for questions.